In 1720, Britain believed it had discovered a machine that could turn paper into gold. Investors lined the streets. Aristocrats mortgaged estates. Shopkeepers liquidated savings. Even members of parliament bought shares. Everyone believed they were about to become wealthy. The company at the center of this mania was called the South Sea Company. It promised access to immense trade profits in South America. It promised riches from exotic lands. It promised a new era of prosperity. There was only one problem. The profits barely existed. The South Sea Company was not primarily a trading company. It was a financial mechanism, a mechanism built to absorb government debt. After years of war, Britain was drowning in liabilities. The state owed massive sums to creditors. The solution seemed elegant. Transfer government debt to a private corporation. Allow that corporation to issue shares. Let investors exchange government bonds for company stock. If share prices rise, confidence rises. If confidence rises, debt appears manageable. The South Sea Company became a bridge between government obligation and market speculation. It offered something irresistible: hope. The promise was simple. Government debt would be converted into shares. Those shares would increase in value. Investors would profit. The government would stabilize finances. Everyone would win. At least that was the story. Early investors saw prices rise. Confidence accelerated. More investors entered. Prices climbed further. Rumors spread of enormous future profits from South American trade. Very few stopped to ask whether Britain even had meaningful access to those markets. Reality did not matter. Expectation did. Speculation fed speculation. The company directors understood psychology. They promoted success. They fueled optimism. They encouraged Parliament to support expansion, and Parliament complied. Members of government were personally invested. This was not an impartial system. Power and profit were intertwined. Share prices rose from around £100 to nearly £1,000 within months. That kind of rise does not reflect trade profits. It reflects mania. London transformed into a marketplace of dreams. New companies emerged overnight. Some promised perpetual motion machines. Some promised secret inventions. Some promised to carry out ventures so vague they were described as an enterprise of great advantage, but nobody to know what it is. Investors still bought in because everyone else was buying. This was one of the first great examples of collective financial delusion. But it was also something more dangerous. The South Sea Bubble revealed how financial engineering, political influence, and public optimism can combine into explosive speculation. It was not simply greed, it was structural. The company was intertwined with state debt. Government stability appeared linked to share price. If shares rose, the system looked healthy. If shares fell, panic would spread. This created incentive to keep prices rising. Directors quietly manipulated supply. They issued shares on credit. They extended easy terms. They encouraged leverage. People bought shares with borrowed money. They believed future gains would cover current risk. Sound familiar? When prices rise rapidly, caution disappears. Early profit validates belief. Belief fuels more buying. Buying fuels more price increases. This feedback loop is powerful, but it is fragile because it depends on constant confidence, and confidence is not permanent. By mid-1720, doubts began to emerge. Trade profits did not materialize. Questions surfaced about valuations. Some insiders quietly sold. The public did not see the exit. They only saw rising prices. Then momentum slowed. Then prices stalled. Then panic began. And when panic begins in a leveraged market, it does not decline gently. It collapses. The South Sea Bubble demonstrated something profound. Markets are not purely rational. They are emotional ecosystems. Prices do not only reflect value. They reflect narrative. And narratives are powerful. The promise of access to South American trade was never fully realized, but the story of enormous wealth potential was enough. Investors believed what they wanted to believe. They saw opportunity. They ignored risk. They trusted authority. They followed momentum. This psychological architecture appears in every major bubble that followed. The railway mania, the dot-com boom, the housing bubble, the cryptocurrency surges. The structure repeats. Different asset, same emotions. Different century, same incentives. The South Sea Bubble was one of the first documented cases where mass speculation merged with state debt engineering. It showed how financial innovation can disguise risk. It showed how leverage magnifies vulnerability. And it showed how quickly prosperity can reverse. But perhaps the most important lesson is this: bubbles feel rational while they expand. They feel justified. They feel intelligent. Only after they burst do they appear obvious. The South Sea Bubble was not an isolated mistake. It was a template. It revealed the architecture of speculative manias long before modern stock exchanges, hedge funds, or algorithmic trading. At its core, every bubble follows a sequence. First, there is a compelling narrative, a story of innovation, a story of access to new markets, a story of transformation. In 1720, it was South American trade. In the 19th century, it was railroads. In the late 20th century, it was the internet. In the early 21st century, it was housing. In recent years, it has been technology platforms, cryptocurrencies, artificial intelligence. The asset changes. The narrative structure does not. Second, there is financial engineering. In the South Sea case, government debt was converted into shares. Credit was extended to purchase stock. Leverage magnified participation. Modern markets use margin loans, derivatives, structured products, collateralized securities. Complexity increases, but the function remains identical. Financial innovation allows greater exposure with less upfront capital. Leverage accelerates ascent, and leverage amplifies collapse. Third, there's political alignment. When speculation aligns with government interest, bubbles grow stronger. In 1720, the British state benefited from rising South Sea shares because it stabilized public debt. In modern markets, rising asset prices support economic confidence, tax revenue, and political stability. When markets rise, leaders celebrate growth. When markets fall, pressure mounts. This creates subtle incentive to sustain optimism. Fourth, there is public participation. Bubbles become dangerous when they leave professional circles and enter households, when everyday citizens begin speculating, when taxi drivers discuss valuations, when family savings move into volatile assets. In 1720, shopkeepers and aristocrats alike bought South Sea shares. Speculation crossed social classes. This widened exposure and intensified collapse. Fifth, there is a trigger. Sometimes it is disappointing earnings. Sometimes it is interest rate tightening. Sometimes it is fraud exposure. Sometimes it is simply exhaustion. Momentum fades, confidence weakens, selling begins, leverage unwinds, and the system that magnified gains now magnifies losses. What makes bubbles so persistent across centuries is not ignorance. It is human nature. Optimism, greed, fear of missing opportunity, trust in authority, desire for upward mobility. These forces do not disappear. Technology accelerates them. Social media amplifies them, but they are ancient. The South Sea bubble occurred 3 centuries ago, yet the emotional script reads like modern headlines. This reveals something uncomfortable. Markets are not solely mathematical systems. They are social systems. They reflect collective belief, and collective belief can detach from reality for extended periods. The South Sea collapse devastated many individuals, but it did not destroy Britain. The financial system adapted, reforms were introduced, trust slowly rebuilt, and new cycles began. That is another important lesson. Bubbles destroy capital. They damage confidence, they punish excess, but they do not end markets. They refine them. They expose weakness, they accelerate regulation, they reset valuations. Then the cycle begins again. Today, global markets are larger than ever, interconnected, leveraged, influenced by central bank policy, integrated across continents. Information moves instantly, capital flows electronically, but the underlying psychology remains unchanged. Understanding the South Sea bubble is not about studying the past. It is about recognizing patterns in the present, when valuations detach from fundamentals, when leverage expands rapidly, when insiders quietly exit, when narratives dominate analysis, when skepticism disappears. Those are signals. History does not repeat precisely, but it rhymes structurally. The South Sea Company promised wealth from distant markets. Modern markets promise wealth from emerging technologies. In both cases, the story was powerful. The leverage was significant, the confidence was contagious, and the consequences were severe. The blueprint remains visible. The only question is whether observers recognize it in time.